Welcome to the Opening Bell Report.
Today, we're going to look at a concept, and I think every single investor, secretly dreams about. You might not admit it at a dinner party, it sounds a little reckless, but deep down, we all want to find it. I'm talking about the Phoenix stock.
The mythological bird rising from the ashes. It's a very romantic idea in finance, isn't it?
It is, exactly. You know the setup. A company that everyone has left for dead. The chart looks like a total disaster zone. The message boards are just full of angry former shareholders.
The media has written their obituary.
And then boom, something changes, a spark. And it just rises from the ashes to deliver these massive, massive returns.
It makes for a fantastic movie script. But I have to be the buzzkill right at the start.
Go on.
In financial markets, usually when a company is left for dead, there is a very, very good reason for it. Corpses, they usually stay corpses on Wall Street.
Usually, yes. But today we are looking at a specific case where the narrative might, just might, support a resurrection. We're diving into a really comprehensive analysis report on a company called Odyssey Marine Exploration, ticker symbol OX.
That's right. And to set the scene properly, let's look at the snapshot from January 23, 2026. This is our starting line.
Good.
The stock's trading at roughly $2.40. It's up about 13% recently, with a market cap sitting right around $133 million.
So it's small. It's a definitive microcap. But the question on the table, and really the whole title of the analysis report we're unpacking today is this the next 10x stock?
Right.
Can a company this size, with all this baggage, really jump 1,000% in value? That's the mission for this deep dive.
It is a bold question. To answer it, we have to look at what the report calls the Phoenix thesis. Essentially, the argument is that for years, OMEX was a binary bet on a single messy lawsuit. That bet failed. Financially, anyway. But now the market is pricing in a massive pivot. They are trying to transition from being a litigation hunter to a national security asset.
Wow. Litigation hunter to national security asset. That is a serious rebranding.
It is. It's like a gambler becoming a diplomat.
Yeah.
And our job today is to figure out if the risk-reward ratio actually supports that hype, or if this is just a value trap waiting to crush investors all over again.
Okay, so before we get to the shiny new potential, I think we have to address the elephant in the room. We have to talk about why this stock was beaten down to $2 in the first place.
Absolutely.
Because until recently, the Odyssey Marine story wasn't about mining at all. It was about a courtroom.
Correct. And this is crucial context. If you don't understand the crash, you can't understand the potential recovery. For years, the investment thesis for OMEX was just the Mexico lawsuit.
Break that down for us. What exactly happened there?
The setup was pretty straightforward. OMEX had sued the Mexican government under NAFTA. They claimed Mexico had wrongly blocked their offshore mining projects for, political reasons, not scientific ones.
Okay.
So investors just piled in. They were hoping for a massive jackpot. The expectation was a payout of around $2.3 billion.
$2 billion. For a company that, as we said, currently has a market cap of what, $133 million?
Yeah.
That isn't just a win. That's a lottery ticket that changes the entire existence of the company.
Exactly. It was an all or nothing bet. And here's the twist that really hurt people. In September 2024, they actually won the case.
They won. So they proved they were right.
They won the legal argument, but, and this is the key, they lost the financial war. The award wasn't $2.3 billion, it was $37.1 million.
Oh, that's a significant discrepancy.
It's pennies on the dollar. It was a disaster. And here's where the details really matter, where a lot of retail investors got burned because they just didn't look at the fine print. That $37 million sounds like a decent chunk of change, right?
Yeah, I mean, it's not zero.
But OMEX had funded this lawsuit through something called litigation finance.
Can you explain that for anyone listening who might not be familiar with it? What's litigation finance?
Sure. Litigation means lawyers, and lawyers, especially international arbitration lawyers suing a sovereign nation, are incredibly expensive. OMEX didn't have the cash, so they took money from a funder, in this case, a group called Poplar Falls LLC.
Okay.
It's essentially a high-interest loan that you only pay back if you win, but because the risk is so high, the terms are very, very aggressive.
So the winnings didn't even go to the shareholders?
Barely. The money was effectively already spent paying back the people who funded the lawsuit in the first place. So the lottery ticket paid out zero to the people holding the stock.
Oh, that is brutal.
So the stock just collapsed. The entire reason people were holding it, that multi-billion-dollar windfall, it just evaporated.
Yeah, they were going to sell the news, except the news was just objectively terrible. So takeaway here, the Mexico trade is officially dead.
Completely dead. Buried. If you're looking at Odyssey Marine today, you have to forget about Mexico. Anyone buying now is buying a completely different story.
Which brings us to the Phoenix part of the discussion. If the lawsuit is dead, they didn't get the payout, why is the stock waking up now in January 2026? Why is it moving?
Because of the strategic pivot, the company has shifted its focus entirely to critical minerals,
And what's the mineral?
specifically phosphate.
Okay, phosphate. I feel like most people hear phosphate and they think fertilizer.
Right, farming.
Yeah.
And that's the old way of thinking. This is where that national security angle comes in. Yes, it's fertilizer and food security is important, but phosphate is now a critical component for LFP batteries.
Lithium iron phosphate batteries.
Exactly. I've heard of LFP. That's the chemistry Tesla. And a lot of the Chinese EV makers are switching to, right?
Right. LFP batteries are becoming the standard for electric vehicles and, crucially for defense applications, grid storage. They're safer than the old nickel-cobalt batteries, they last longer, and they're cheaper.
But to make them, you need phosphate.
A lot of it.
A lot of it. And this is where geopolitics plays a huge role. The United States is actively trying to secure domestic supply chains. Right now, a huge percentage of the world's processed phosphate comes from China.
I see.
So the Department of Defense, the Department of Energy, they are frantic to stop relying on geopolitical rivals for these materials. They need a domestic source.
So the wind is at their back, politically speaking.
Okay.
But let's be real. Wanting phosphate and having phosphate are two different things. Do they actually have the goods?
They believe they do, and the analysis report highlights a specific trigger event that's driving this recent price action. Late last year, in 2025, OMEX filed for a U.S. offshore mineral lease, and the BOA...
That's the Bureau of Ocean Energy Management.
Correct, the BOEM. They've initiated a formal review.
That sounds incredibly bureaucratic. Initiated a formal review. Why is that a big deal? It sounds like paperwork.
It sounds dry, but it's the spark. I mean, think about the contrast with Mexico. In Mexico, the government was hostile. They were fighting the company every step of the way.
Right.
Here, the U.S. government is seeking these resources. They have a congressional mandate to find them. The BOEM review is the first step toward unlocking what the report calls a potential home run asset. It means the government is taking this seriously.
So the thesis shifts from suing a government to partnering with a government.
That is the hope. And the scale of this U.S. phosphate project is what drives the valuation numbers we'll get to in a minute. It's the difference between a small project and a truly world-class resource.
Before we do the math, I want to ask about their other assets. Because if the U.S. government decides, no, we don't want you digging up the ocean floor, is it just game over?
Is it a one-trick pony? Not necessarily. They do have a secondary asset, which the report describes as the floor. It's a project in the Cook Islands.
The Cook Islands. That's in the South Pacific, right?
Correct. A small island nation. But the water around it is incredibly valuable. They're looking for polymetallic nodules there.
I love that term, nodules. Sounds like something from a sci-fi movie. What are we talking about?
It's fascinating geology. These are basically potato-sized rocks sitting on the deep sea floor that contain high concentrations of cobalt, nickel, copper, manganese.
And they just sit there on the seabed.
Literally just sit there. And that's the key differentiator. Usually when you think of mining, you think of massive open pits, dynamite.
Ecological destruction.
Exactly. With these nodules, you don't dig. You harvest them. The technology is almost like a giant vacuum cleaner on the ocean floor. It sucks up the nodules, separates out the mud, and sends the rocks up a riser pipe to a ship.
That sounds cleaner. But is it really?
Well, that's the big debate. In theory, it disturbs the environment far less than terrestrial mining. You aren't chopping down rainforests in Indonesia to get nickel. But you are disturbing the deep ocean floor. And environmentalists are, very concerned about the sediment plumes and the impact on deep sea life.
It's a classic green energy paradox. To save the climate with batteries, we have to mine the materials, which hurts the environment.
Exactly. But from a valuation standpoint, the Cook Islands project is distinct from the U.S. one. The partnership between the U.S. and the Cook Islands has been strengthening. So while this isn't the 10x driver, it provides a kind of valuation safety net.
So it's not the main event, but it keeps the lights on.
It gives the company a baseline value, yes. The report estimates its value between $50 million and $250 million, depending on when production actually starts. But if you're buying for that 10x return, you aren't looking at the Cook Islands.
You're watching the U.S. phosphate lease.
That's the one.
Okay, let's unpack this math, because 10x is a huge number to throw around. How do we get from a share price of $2.40 to, what, $25?
That's the target in the bull case. Let's walk through the asymmetric bet detailed in the report.
Lay it out for us.
Right now, the market cap is roughly $133 million. That's the price tag for the whole company.
Tiny.
Tiny. Now look at the asset. If the U.S. phosphate lease is granted, the report states that the deposit is valued at $1 billion to over $2 billion in gross resource value.
So, wait. You have a $130 million company sitting on a potential $2 billion asset.
Correct. And that's the get. If that approval comes through, the company re-rates. It stops being a penny stock with a failed lawsuit and becomes a major strategic resource holder with a U.S. asset.
And what does that do to the share price?
The report models a total enterprise value hitting $1.45 billion in a success scenario. If you divide that by the fully diluted share count, you get an implied share price of approximately $25.
That's the definition of a re-rate, a massive jump.
It is violent upside. But you have to understand the mechanism. It's not about slow growth. It's not about selling 10% more widgets next quarter.
Right.
It's a binary event. Right now, at 240, the market is basically assigning, a 10 to 15% probability of success?
So the market is very skeptical.
Very. They've been burned before. But think about probability arbitrage. If news breaks, if the BOAM releases a positive environmental impact statement, or if the lease is actually signed, that probability doesn't go to 100% immediately. But if it shifts to 50% or 80%,
the stock price has to explode to catch up.
It explodes to catch up with the asset value. You aren't betting on the price of phosphate going up. You are betting on the probability of the permit going up.
A trade on regulatory approval?
Precisely. A bet on the government signing a piece of paper.
Okay, that's the dream scenario. $25 a share, we all retire early. But I have to play the skeptic. You said earlier that usually when things are left for dead, there's a good reason. What happens if this goes wrong? Is there a zero scenario?
There is absolutely a zero risk, or at least a near zero risk. The report outlines 3 major dangers. This is not a savings bond.
Give us the nightmares.
First and foremost, the dilution death spiral.
That sounds terrifying. What does that mean practically?
It comes down to cash flow. OMEX has effectively zero revenue. The report cites $467,000 in trailing 12-month revenue.
That's nothing.
That's nothing for a public company. That doesn't even pay for the coffee in the break room.
So how do they pay the bills? The geologists, the lawyers?
They sell stock, they print new shares, they survive by diluting the existing shareholders.
So every day that goes by without a lease is a day they're burning cash and making your slice of the pie smaller.
Exactly. If the U.S. lease is delayed by even 12 months, the report estimates they may have to dilute shareholders by another 20 to 30% just to keep the lights on.
Time is the enemy.
Time is the enemy. The second risk is a regulatory no.
But you said the U.S. needs phosphate.
They do. But that doesn't mean they will approve offshore mining in U.S. waters. I mean, we're talking about the ocean. The fishing lobby, environmental groups, coastal tourism boards.
They could fight this just as hard as the Mexican government did.
Absolutely. Just because it's strategic doesn't mean it's guaranteed. Politics is messy, and not in my backyard is a powerful force.
That's a fair point. And the third risk?
The debt overhang. The balance sheet is, frankly, ugly. They have significant debt loads. They need cash now to reach the payout later. It's a race against solvency.
So if we look at the bear case valuation, the everything goes wrong scenario, where does the stock land?
If the U.S. lease is denied, the value drops to just the Cook Islands stake plus whatever cash is left. The model puts the implied share price at around 90 cents.
So $2.40 down to 90 cents. That's a 60% haircut.
At least. It really is a binary outcome. $25 on one side, 90 cents on the other.
Wow.
That's why the report emphasizes this is an asymmetric bet. The upside is 10x. The downside is roughly 0.5x. Mathematically, it's attractive. If you ran that simulation 100 times, you'd make money. But emotionally...
Emotionally, it's very difficult to hold a stock that could lose half its value overnight.
It requires a stomach of steel. And it requires knowing why you are holding it. You're holding it for a press release from the government.
So, bringing this all together, we have the Phoenix thesis. A dead lawsuit, a new strategic pivot, a massive potential asset. What's the final verdict from the analysis report?
The verdict is crystal clear. This is not an investment.
Not an investment. That's a strong statement.
No, it is a venture capital bet that happens to be trading on a public exchange. You shouldn't put your retirement money in this. You shouldn't put money in this that you can't afford to lose 100% of.
That is a crucial distinction. It's speculative capital.
The report suggests a buy zone under 220 using technical support levels. But the most important thing is the signal.
What are we watching for? If I put this on my watch list, what alert should I set?
The BOM lease grant. Don't watch the stock price zigzag. Watch the government newsfeed. Watch the Federal Register. That is the specific event that triggers the re-rate.
And if you can't stomach a 50% drop because of a bureaucratic delay,
then stay away. This is for the risk tolerant only.
It's a fascinating setup. You know, we often talk about stocks like they're just lines on a chart or, purely about business execution, sales, margins.
Right. Usually if a company executes well, sells good products, the stock goes up.
But here, the difference between 90 cents and $25, the difference between failure and a 10x return has almost nothing to do with business execution. The phosphate is sitting there regardless.
It is.
It's entirely about a government signature.
It really is. The geology hasn't changed in millions of years.
Right.
The only thing changing is the paperwork.
And that leaves me with this question for you listening. Does that make this a trade on mining? Or is it actually a trade on bureaucracy?
That is the question.
Thanks for diving deep with us. We'll catch you next time.
Don't forget to like, share, and subscribe for more.